a basic example futures trade to show how this can play out. Let's say trader A is bullish on the S&P 500 and buys a micro E-mini futures contract. You can short or sell futures, but in this video, we're just going to focus on going long, which is another way of saying buying. For this example, we'll say that MES is trading at 5,600, which is a notional value of $28,000. Notional value is the cash equivalent value to owning the underlying asset or the contract's total value. In other words, if you wanted to buy a portfolio that reflected the S&P 500 with the same value as an MES contract, you'd have to invest $28,000. However, by using a futures contract, trader A can put down a fraction of the contract's $28,000 notional value. Margin is set by the futures exchange and is typically 3% to 12% of the contract's notional value. Some brokers may choose a higher requirement. Therefore, initial margin can change at any time. In this example, let's say the initial margin requirement is $2,073 for trader A, plus commissions and exchange fees. There are two margins they need to be aware of when trading futures. In addition to initial margin, there's also maintenance margin. Maintenance margin is lower than initial margin. Typically, the initial margin requirement will be 110% of the maintenance margin requirement. When traders first enter a futures position, they need to put up the initial margin requirement. However, after establishing the position, traders are held to the maintenance margin requirement. Falling below this maintenance requirement would trigger a margin call. Let's look at an example to help illustrate initial and maintenance margin levels. For this example, trader A has an initial margin of $2,073, their maintenance margin is $1,885, and their account balance is also $2,073. The cash for the initial margin is automatically set aside in their account once the order is entered. The next day, the S&P 500 falls 20 points. Let's see how this affects our trader. There's minimum price fluctuation for contracts called the tick size, and for MES it's 0.25 index points, or $1.25 per contract. The notional value of one contract is calculated by multiplying the current level of the index by $5. It's called the multiplier. Both are set by exchanges like CME Group or CBOE and vary from contract to contract. So with the S&P 500 falling 20 points, trader A loses $100.